Hello, and you're again. Welcome back to Global Business Insights after a short media break. As always, we look deeper at headlines from a business perspective. Elon Musk is moving the headquarters of his rocket firm SpaceX and his social media company X from California to Texas. The main offices of Tesla also moved there in 2021. The billionaire said the final straw was a new law in California banning schools from requiring children to notify parents of a change in their child's gender identity. Tomorrow, the European Central Bank is expected to leave interest rates unchanged after delivering the first reduction since the COVID-19 pandemic last month. And King Charles III has outlined the UK government's legislative plans for the year ahead at the state opening of Parliament. The agenda, which includes about 40 bills, the Prime Minister says will take the brakes off Britain. Early in the morning, UK inflation held steady at the Bank of England's target of 2% in June, with cost of living increases at the lowest level in nearly 3 years. Services inflation, which tracks categories such as hospitality, culture, and housing, was unchanged at 5.7% in June, which was higher than economists' estimates. In Nigeria, inflation that came out on Monday continues to inch higher. We'll look at implications and what the Monetary Policy Committee would do or could do when it meets next at the end of the month. We also gather that Nigerian President Bola.Tinubu has asked lawmakers to allow a one-time windfall tax on banks, with a request to increase government spending by as much as $3.8 billion. Windfall taxes, especially in Europe, have pretty much been the norm given the pressure on the fiscal purse of many governments and the need for the corporate sector to pay a little bit more to meet some of the gaps. In its report, the IMF calls it a global economy in a sticky spot. We also examine the IMF latest update. But first, the King's speech.
My Lords and members of the House of Commons, my government will govern in service to the country. My government's legislative programme will be mission-led and based upon the principles of security, fairness and opportunity for all. Stability will be the cornerstone of my government's economic policy, and every decision will be consistent with its fiscal rules. It will legislate to ensure that all significant tax and spending changes are subject to an independent assessment by the Office for Budget Responsibility. Bills will be brought forward to strengthen audit and corporate governance alongside pension investment. Securing economic growth will be a fundamental mission. My government will seek a new partnership with both business and working people and help the country move on from the recent cost of living challenges by prioritising wealth creation for all communities. My ministers will establish an Industrial Strategy Council. It is my government's objective to see rising living standards in all nations and regions in the United Kingdom. My ministers will get Britain building, including through planning reform, as they seek to accelerate the delivery of high-quality infrastructure and housing. They will also pursue sustainable growth by encouraging investment in industry, skills, and new technologies.
King Charles III has outlined the government's legislative plans for the year ahead, which included plans on nationalising the railways, speeding up delivery of high-quality infrastructure and housing, and setting up a state-owned energy company to accelerate transition to cleaner fuels. The new Great British Railways, an arm's-length body, will manage both tracks and trains and work to improving processes. On migration, it aims to modernize the immigration system and establish a new border security command. It will also remove VAT exemption for private schools to fund more teachers in schools. Although the direction is to strengthen fiscal watchdogs like the Office for Budget Responsibility, a bigger government does sound like a more expensive, bureaucratic, and less efficient government. Expanding government and regulations can drain the public purse, adding pressure to raise more taxes. Reform UK's deputy leader, MP Richard Tice, says the speech represents more taxes, more bureaucracy, more regulation, adding that GB Energy with increased investment in renewables will add to costs, so people pay for more expensive energy. There are populist elements such as expanded workers' rights and protection to those renting, including ending no-fault evictions, banning exploitative contracts, improving access to parental leave and sick pay to new employees, strengthening statutory sick pay, and making flexible working the default from day one for all workers. Other measures include giving the Bank of England new powers to deploy hitherto unavailable funds to help resolving problematic smaller banks, and creating a stronger UK audit regulator with powers to punish company directors who failed to publish accurate accounts. Liz Truss has said that the King's speech showed Labour had no idea about the change Britain needs. She says measures expand the power of the unelected state and also increase red tape on families and businesses. Others say it's good to see a much needed focus on industrial strategy and skills and areas of critical importance to growth and prosperity that have been neglected for too long. Like with all plans, it's the execution that makes all the difference, and the learning in terms of when to dump or tweak ideas not working as expected, having broad metrics to continuously track impact. It's also not clear how broad a mandate the Labour government enjoys to push such a transformational agenda. I guess we won't know till the next elections. Yesterday, in its latest July IMF economic update, we see just tepid economic growth almost everywhere, meaning capped oil prices, more geopolitical upheaval, and the increased need for every economy to be proactive in protecting citizens from fallout of economic weaknesses on the vulnerable. In its updated report, themed global economy in a sticky spot, we see services inflation holding up progress on this inflation and complicating monetary policy normalization. Three issues are striking in the report. The issues all weigh on future growth. First, further challenges to disinflation could force central banks to keep borrowing costs higher for even longer than we presently expect. Higher rates for longer puts overall growth at risk, with increased upward pressure on the dollar and harmful spillovers to emerging and developing economies. Second, it says fiscal challenges need to be tackled more directly. The deterioration in public finances has left many countries still more vulnerable than foreseen before the pandemic. More are also getting trapped in debt as it calls for rebuilding fiscal buffers. Third, there is a new trend of unilateralism in trade countries, as everyone seems to be going their own way, imposing unilateral tariffs and measures whose compliance with World Trade Organization rules are, of course, questionable at best. Also, the IMF launched its AI Preparedness Index, showing rankings across 174 countries based on indicators such as digital infrastructure, human capital and labor market policies, innovation and economic integration and regulation and ethics. Singapore, Denmark and the United States lead the index globally, with Singapore number one with a strong 0.8 points, while in Africa, South Africa scored 0.5, Kenya 0.45, Ghana 0.43, Namibia 0.42, Botswana 0.41. Nigeria is ranked below average, scoring 0.34. And in Nigeria, according to the National Bureau of Statistics, inflation inched up to 34.19% in June, from 33.95% in May 2024 for the 18th consecutive month, driven by high food inflation. Month-on-month headline inflation also grew by 0.17% to 2.31% in June 2024 from 2.14% in May. This was also the first increase in month-on-month inflation after a recent trend of declining month-on-month price increases. According to Stanbic IBTC, S&P Nigeria PMI sank to a 7-month low of 50.1 in June, further down from 52.1 in May. However, purchasing activity and inventories increased on efforts to get ahead of expected future price rises. But on the price front, elevated prices in June linked to currency weakness and higher raw material costs, particularly those related to animal feed, led to companies raising their selling prices sharply again in June. Business confidence was also said in the report to be close to the lowest on record. On inflation, all eyes will be on the Monetary Policy Committee, which has raised interest rates by 14.75 percentage points since May 2022 to 26.25% and may still hike rates again at its next meeting on July the 23rd. The Apex Bank had signaled that inflation will ease around April, May, and so will be concerned with the latest sticky prints. Still, the impact of the scaling back of gasoline subsidies a year ago and currency devaluation on inflation should start to recede, and measures such as importation of food to improve supply and suspension of import duties on certain food staples should reduce costs. Also, it was reported that farmers in the nation's central region are seeing better harvests of Irish and sweet potatoes, which is resulting in prices crashing. Higher inflation weighs on growth and worsens poverty. The urge to raise rates by the Monetary Policy Committee should be tempered by concerns that the economy is already being crippled by high cost of borrowing, and more needs to be done on supply side reforms such as the bottlenecking supply chains, reducing costs of doing business. The MPC needs to factor in the lags between rate action and impact on prices, which also can confuse the dynamics. Some good news, however: capital importation in Q1 2024 saw a huge spike from $1.088 billion in the previous quarter to $3.376 billion. However, foreign direct investment, which has a more direct correlation to stable economic growth and jobs, fell from $183 billion in Q4 last year to $120 million in Q1 2024. Higher portfolio flows are a sign of an improved investment climate, and as confidence continues to improve, FDI growth is expected to follow. Analysts are still urging for more structural reforms, warning that half-cooked reform and tactical measures will not be enough. Managing the pain requires more proactive planning. The government is expecting a J-curve recovery trajectory as it pushes reform, but it has to be sensitive to managing what looks like a lingering downtrend, focusing on how to ameliorate pains in view of the acute absence of familiar safety nets available in other countries. I would advise slashing down cost of governance of the current government by at least 30%, holding on interest rate hikes and waiting for the impact of supply side reform while bringing down business taxes and pushing new structural reform to help economic growth. To close, European stocks were mostly lower, continuing negative sentiment seen in the previous two trading sessions, this time with technology stocks struggling even more. The moves came after reports that the Biden administration is considering more rules to clamp down on companies exporting critical chip-making equipment to China. Trump had also commented that Taiwan may need to pay the US for defense, adding that Taiwan was taking semiconductor business from US players. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Again, thank you so very much for watching. Bye-bye.